Welcome back. It has been a dismal year for college endowments. In the past year, both Harvard and Yale estimate they lost about 30% on their investments. But someone may benefit from the Ivy League's mistakes. PIMCO fund manager Mohammed Al-Arian. Let's bring in Bloomberg's Jillian Wee for more on that story. Jillian, welcome. What does Mr. Al-Arian have to do with these endowments?
Well, he previously ran Harvard's endowment. As you know, he left in the end of '07, joined PIMCO in '08, and now he's the head co-chief investment officer of PIMCO. One of his guys, Mark Taborski, who was also previously at Harvard, is developing a strategy that will be endowment-esque with a little twist. It'll be more liquid than the top endowments to make sure that funds aren't caught in somewhat of a cash crunch that we saw schools in the past year.
A little bit liquid because of the sign of the times and because of the economy we're in?
I think the idea is to be liquid enough to shift in and out of assets, take advantage of opportunities, not get stuck in hard-to-sell holdings like private equity and real estate that endowments found difficult to shed unless they wanted to take steep discounts in the past year.
Jillian, as you briefly mentioned, Al-Arian ran Harvard's endowment from February '06 to December '07. How does this influence the fund's current strategy?
Well, I'm not quite sure about that. I mean, we talked mostly to one of his managers, Taborski. I would say that during Al-Arian's time at Harvard, he posted one of the biggest gains, fourth biggest gains in the endowment's history. And I think the idea is to learn from managing an endowment and sort of switch that to adapt to what endowments and investors need to do going forward.
Talk more about how PIMCO's current strategy differs.
Well, I guess if you look at the top endowments, Harvard and Yale, they've historically operated on little or negative cash. Last year, Harvard operated on a negative 3% cash, which meant that it had to borrow to cover that, and it amplified gains. So PIMCO's idea is to have more cash, to be more fluid, to shift in and out of, say, equities into, other asset classes if they need to for strategy and in case, no one wants to be caught in a cash crunch.
Right. So how did PIMCO know, or where did the idea stem from to go with this strategy from the endowments?
I think they were going after investors who want to achieve endowment-esque returns. I mean, endowments for a long time were seen as some of the smartest investors. I mean, they invested for the long run, taking on risky assets like hedge funds and private equity because they needed those returns to run the university. And so that became sort of a model that pension funds and other investors started looking at and emulating. PIMCO is doing this for investors who perhaps can't access managers that they would otherwise be able to access if they were as part of a larger institution.
And so what we're seeing PIMCO learning from Harvard and Yale's mistakes?
Somewhat. I mean, I think that the biggest lesson when I talk to endowment managers is the lack of, people didn't think about liquidity enough in the past year. And so now when you talk to endowment managers, one of the biggest things that comes up is we're increasing cash in our fund, as Harvard is doing, and we're just being more cautious about the future.
Jillian Wee, Bloomberg News, thanks so much.
Thank you.